Welcome to this episode of the Hidden Money Podcast, where Kevin and I are going to discuss how charitable giving can slash your tax bill. That's right, you can do good and reduce your tax bill, which in my opinion is doing good anyways, right? So it's like the best of both
Yeah,
worlds.
you're hitting 2 birds with 1 stone. You're being kind
Absolutely.
and generous, and you're not giving the government your money.
And that's the definition of being a good steward over the money God's given you, right? Use it wisely. Use it in ways that reduces your taxes.
Yeah, and there's so many ways to structure charity. It could be as simple as giving cash to a 501(c)(3). That's the whole foundation of charitable giving on the tax side. It has to be to a 501(c)(3). It has to be to a registered charitable organization. You can't just give random cash to people on the streets or give cash to your friend and consider that a gift or some sort of giving. It actually has to be to a charitable cause that files a tax return and all this kind of stuff. So not every dollar you can give is for the benefit of your taxes, nor should it be, but you could structure things in a certain way so it's more advantageous on your taxes than just straight giving.
And there's so many ways to do it. Like you said, charitable giving, something everyone is used to is like when the Boy Scouts come knock on your door and say, "Hey, we're doing a fundraiser. Can you give us money?" That's charity. They're a registered nonprofit. You give them money, they have to give you a receipt. Can you go through some of those rules just for standard, typical charitable giving? What do you need to be able to take the deduction and have no problems if the IRS challenges you?
So documentation is always key. I mean, if you give cash, obviously that cash is not going to be there, but the charity also has to report that cash. And when they report that cash, they're also going to issue you hopefully a letter. And now we might have all received those letters when you get them at tax time saying no goods or services were received in return of this gift. And it'll have the charitable cause. It'll have the EIN of the charity on there. It'll have the amount donated. And if there were services or if it was an auction and there was some sort of benefit to you giving that money, though they should put that value in there. And the difference is your gift versus your benefit. That's your charity.
Yeah, let's talk about it just for a second because I know that confuses a lot of people, but um, it's something that's been around for a while. I don't know the exact time on it, but there was a tax court case that ultimately required if you're doing something like you go to a charitable auction, like my son's school has those, and you buy something, you get like a signed football or something, but you pay it's worth $100. You pay $1,000 for it. The IRS and the general rule of thumb is, hey, if you're getting something out of it, whatever you're getting out of it, you don't get to deduct for tax purposes. Well, there's a more hairy and more complicated case that went through the tax courts, and tax court came up with a very bright line. Says if you receive anything, as a matter of fact, it's best practice for every charity to point out that either no goods or services were received or what the value of them is. And this is just for cash gifts. We're going to get to property gifts in a minute.
Yeah.
So you need a receipt.
Need a receipt, just like with any ordinary business expense you may incur if you're a business owner or any other tax deduction, documentation, the burden of proof is always on the taxpayer. So if you have that letter, that's more than sufficient because that is coming from a third party and it's verifying that you can take the write off. Now, charitable giving is not always for tax purposes for everybody, just because you also have the standard deduction. So that's part of the foundation too. Foundation one, let's just see, how do we defend ourselves? What constitutes as a gift? 501(c)(3), get your documentation, get your letter. The other part of this is for you to get a benefit from it, you have to take itemized deductions on your taxes. So not everyone who gives to a 501(c)(3) will actually receive the tax benefit because they might just take the standard deduction anyway.
That's very true. So be careful. Talk with your tax advisor, or go consult your tax software if you're doing self preparation. If you are taking the standard deduction, which more people do now than used to because the standard deduction is a lot bigger and they're about to be made a lot more bigger and for longer in the new big beautiful bill, assuming that actually passes. But if you don't itemize your deductions, you get a few $100s of a
Do
charitable
you get it
deduction.
above the line now since
$300.
yeah, it's very small.
It might change with the new tax bill. We're not sure yet how that's gonna play out. But if you're not itemizing, you don't get that deduction, so be careful and think about it. Um, we're probably skipping ahead to getting this strategy, but let's say you do take the standard deduction most years. But if you want over the next 3 or 4 years, you know you're gonna give so much amount of money to some charity or to your church or to a university. If you're gonna do that, we call it bunching. Can you kinda go through that process and how that works?
Yeah, there's actually 2 strategies that we'll kinda go through about if you're taking the standard deduction, how to actually utilize charitable giving on your taxes. Bunching is the first one we'll get into. Bunching just means you're gonna time your charitable giving a little more creatively because remember, from a tax standpoint, we're worried about deductions from January 1st to December 31st. Any cash or check given in that time period is gonna go to that tax year. So let's say you're going to give $15,000 to your church every year. Well, and let's say you don't own a home or whatever your situation is, that's the only itemized deduction you have is 15,000 and you're married. Well, the itemized deduction limit is mid 20,000s
Or the standard deduction?
or standard deduction, sorry. The mid standard deductions like 25. So let's say you give 15 every year. That 15 is going into the abyss because you're not getting any benefit from it from the tax standpoint. But what if you creatively structured your charitable giving to where on January 1st, you give all of last year's donation January 1st, the 15,000, you save up for it, invest it or whatever you do, then January 1st, you give 15,000. Then you do your normal giving throughout that current tax year. So that tax year, you actually have $30,000 of charitable giving. You've given the same amount of cash between the 2 years. It's just you're saving and being more strategic with it. Um, then you're actually pushed into itemization because you're above the standard limit. So that's what bunching is. It's bunching 2 years of charitable giving in one tax year.
And even though this episode is focused on charitable giving, if you're gonna be doing bunching for charitable giving, make sure you're bunching for the rest of your itemized deductions as well too. So, we'll get into that in another episode,
Property
but they
tax.
should go together.
Yeah, when that salt cat goes up with this big beautiful bill, you could bunch your property tax too. Normally, we haven't been doing that lately, just because, and that's a very common strategy, is because you can pay your property tax December 31st and January 1st, and you can kind of be a little flexible, just as long as you pay them eventually. But when the salt cap goes up, heck, you could bunch both. It's a good idea. Then you're really itemizing.
So we talked about giving standard, just normal, simple cash donations. I think everyone's pretty familiar with that. You can also do other things. I think the most other one that people are familiar with is giving to Goodwill. You've got a bunch of clothes in your house, or cleaning out your closet. Um, your kids have grown up. You got a bunch of toys to give away. You could go take them to the curb, or have a garage sale, or get a tax benefit and donate them. But when you're donating property, there's a whole different set of rules you need. The IRS is very used to it. They've caught a lot of people fudging their Goodwill donations because you go to Goodwill, they just give you this blank receipt.
Yeah,
They
they
figure
they
they're
sign
doing you
it.
a good favor,
Yeah,
right?
they're like, you figure it out.
Yeah. And so when our clients come to us and they're like, I gave a bunch to Goodwill and they give us, 20 blank receipts with signatures on it. I send it back.
Like, what do I do with this?
Yeah, what are we supposed to do with it? And don't leave it up to your CPA or your tax preparer to figure it out because that's Canadian tax fraud. We're not allowed to guess it. Yeah, we need to know what it is. So the actual requirements are that receipt needs to be given to you at the time of your donation, and it needs to be filled out, and it needs to have ascribed values to each item you gave. Don't see people doing that very often. I would highly recommend if you're giving to Goodwill, you push them back and say, "Man, I'm giving you all my kids' toys. Just please fill out the receipt so my tax guy doesn't yell at me at the end of the year."
Yeah. Yeah, and you could there's so many valuations online that you could do, and we could probably look at those, but it's general rule of thumb is you're never gonna deduct the cost. Very rarely are you gonna deduct the cost of things that you donate to Goodwill. You deduct the fair value at the time. So if you buy a bunch of toys and let's say, you buy $500 worth of toys and they outgrow them over the course of 3 to 4 years, and you take that $500 worth of toys and give it to Goodwill. Well, your kid stomped on it, broke some pieces, you don't have all the pieces, it's not worth what you got for. So that $500 lot of toys is maybe worth $100 or $150 or something. So you deduct the 150, not what you paid for it. It's the fair value at donation. So you need to put a valuation on that so that you can actually substantiate the deduction. And it needs to be reasonable. You can go on eBay and just say, hey, what are these toys going for? And you can kind of get pretty close.
Yeah. Um, You don't have to get an actual certified valuation until that property value you're donating is worth a lot more. We'll get to that in a minute. But you do need the value, and they're not doing you a favor if they leave it blank. The standard rule of thumb, it's even an option that we fill out on tax returns on the property donation statement on your tax returns. The thrift shop value. What would this cost in a thrift shop? In a thrift shop, and you're allowed to get that. Occasionally, you'll have like appreciated items. Did you ever have Garbage Pail Kids when you were a kid?
Yeah.
Those
Oh, yeah,
cards?
yeah.
I collected the heck out of those. Do you know how much they're worth these days?
Oh, I would imagine
Yeah.
they would gone up.
So, I actually have 4 unopened packets with the chewing gum still inside because I can see the outline of Garbage Pail Kids. I'm not donating them, but apparently like, it's a gamble. If I open them and find out they're one of the specific cards that are worth $20,000 today, it's a gold mine. But if it's just the normal cards that aren't worth that much, are worth like $100 a piece, by opening that package, I reduced the value by like 3x. So, not sure what I'm gonna do with those. But let's say you have the Garbage Pail Kids or some other appreciating asset, like a Cabbage Patch doll. Um, if you're gonna donate that, you can get a higher value than your cost basis. It's what the value is. But if it's gonna be a lot, then you gotta get the appraisal. So talk about the $5,000 rule.
Yeah, $5,000 rule. So just like you said, if the value is over $5,000, we need to do a little bit more due diligence on this. You need to actually have a valuation done. We've actually had clients donate horses
Mm.
to
Racing horses, that's what
racing.
yes.
Yeah, to I think it was to a high school that they had like some sort of what is it?
As
Aquarian, what is it? So they donated this horse and it actually appreciated. It was like
equestrian.
equestrian.
There we go.
You're the man.
Thank you.
That's why I got you. But yeah, that horse, they didn't. I mean, I don't know what you pay for a horse. I'm not a horse guy, but it was like a $35,000 horse at the time, and they donated it to the high school. So it actually had to have a valuation done, and we had all the paperwork done and everything. So you have to actually tie those loose ends up. You can't just donate a car and be like, $12,000. Sure. You need to actually do a little bit more on there.
It's an actual written requirement in the law. If it's worth more than 5,000, you have to have an appraisal or an evaluation. It's not necessarily required for smaller items, but my rule of thumb is if it's 2,500 or more, get some reasonable valuation or something to document it. Because again, the IRS has caught a lot of people cheating at this. So just be able to back it up, right?
Yeah, and you gotta file a different form on your tax return. It's not as simple as just listing it on the Schedule A as a charitable giving. Now, you can give cash any amount above $5,000. Cash is cash. It's automatically kind of evaluated. So you could just put all your cash donations, but if you're donating appreciated property over 5,000, it requires a different form, a little more detail. You gotta disclose all that. But donating appreciated property is actually very common, and it could be done not just with like artwork and baseball cards and comics and horses, but stocks. Stocks are very common to donate, and that is something that is um, much more likely given the market. Let's say you're sitting on a large capital gain. Let's say you've invested, you made some good stock calls and some good investments, and you invested, let's say $10,000 and you grew it to 50 over the course of 10 years or whatever. You're sitting on this big gain. You don't want to sell the stock and then give the money to your charity. If you're going to give to charity
What happens if
anyway,
you sell it and then give it charity?
you're going to capture gain,
So
right?
you sell it, you recognize taxable income, but then you can give it to them, but it's a wash,
It's a
right?
wash. Or what if you just went directly to the charity with the stock? You could do that. You can give that $50,000. And this is small sidebar. Charitable giving is great when it's your heart that's giving. We never recommend that you go and give to a charitable cause for the sake of taxes. In very few instances does that even make any remote sense in the world. For any dollar you donate, you're going to save 37 cents max for every dollar you donate. It's if you're not charitable minded or like a mission with your giving, just save your money. Do not donate it to save taxes. That makes 0 cents.
And that's a good rule 99.9% of the time. We're gonna talk about some other strategies here in a minute where sometimes it does make sense, but as Kevin and I like to say over and over again, don't let your tax tail like your business or financial planning dog. Um, but yeah, so if you have stock, it's appreciated, you could turn around and sell it, recognize the gain, but then give that gain back to the IRS and probably be able to even it out to where you're not recognizing any income Well, you are recognizing income, but you offset it with the charitable deduction. It doesn't get you anything. You give that stock directly to the charity. Make sure you have receipts, do your documentation. Not only do you not have to recognize the gain, you get a deduction for the fair value of it. Much better. I've seen a lot of in the past 25 years, I've probably had 2 or 3 dozen clients sell stock and give it to charity, or at least sell a big piece and then just give like 10% to the charity. I'm like, "No, why'd you do that? We lost all the opportunity here." So don't do that, please.
Yes, don't do that. It's much better just to give direct. And if you know you're gonna give a set amount that year to that charity, you can start you don't have to do all the stock, it's not all or nothing. You could sell some, donate some shares to cover the amount you wanna give to that church, and then the church is in control of the actual shares, and they're free to sell it or whatever they wanna do with it. Um,
Really quick, let me just go on this tangent for a second because I know a lot of people have heard of conservation easements. I mean, that was a big deal for 20 years. Let's just go over the quick basics of that. Used to be able to you go into a partnership, put in $100,000, and a bunch of other people put in their $100,000, and they go and they buy this land with a mortgage, and then donate it to the Sierra Club or something. They were able to get like 5 times. You put in the 100,000, you got a $500,000 charity. The IRS hated it. There was a time for almost a decade, the Treasury Department had over 1,000 attorneys focused on trying to stop that. They couldn't do it, but then they got Congress to change the law a couple years ago. You can't do it anymore. The law is it can't be more than 2.5 times the donation that you put in. When you work that out with tax rates at 37%, you can't get a bigger deduction than the money you put in. It's the same thing. You have to have a holding period, but there are other kind of leveraged charitable options, and some of them still hold water. Just be very, very careful. Someone's peddling that to you on TikTok, or a friend's friend is trying to get you to do it. Be very careful. There are some legal ways still out there to get a leveraged charitable deduction, but most of the ones I've seen being peddled out there ain't gonna hold water with the IRS.
yeah, I wouldn't even advise any of my clients to do any sort of conservation easements anymore. The risk is not worth it. There's a lot safer products out there that you can get a much better ROI on, and it requires a lot less risk.
Yes. And yeah, and that has other things besides conservation easements. But even those, like you said, there's some good ones out there that are not conservation easements. That can give you a 4x or 5x sometimes, depending on the facts and circumstances deduction. But on those, I also see a bunch being peddled that are going to get you in trouble. So be
Yep.
careful.
Yep. And we're gonna get into that in a future episode. We're gonna go over kind of some of the red flags and some of the dirty dozen too of the IRS. And one of the dirty dozens as a teaser, social media is a huge part. The IRS is recognizing that there's a bunch of
Not
bunk
just social
tax
media, they
advice.
actually clearly call out TikTok.
TikTok.
Yeah,
Yeah. The IRS actually says TikTok users are giving you bunk advice. Stay away. It's causing
that is
issues.
true. Um, I don't know if we're ever gonna put any shorts on TikTok here, but be careful now.
Yeah, we
Maybe
got
we'll
to
just
make
stay
sure we
away
know what
from
we're doing.
TikTok. Yeah, we'll just stay away because IRS thinks if you're on TikTok, you're a bad tax
Yeah.
practitioner.
Yeah, I'd also like to kind of touch on one thing too when talking about donating appreciated property in the stocks. If you're taking a standard deduction, and these are for a certain group of people who are mostly subject to RMDs, the required minimum distributions. They've worked their life, they've saved their money, they got their deductions during their working years by contributing to a retirement account, 401k or an IRA or something along those lines. Then when they hit retirement, the government's like, "Hey, we gave you all that tax deduction. Now you've reached the age where we're going to require you to pull money out of your retirement account. You have to now, um, because we want our tax. We don't want you to just keep shielding your tax from us until you die, and then it goes to your heir. We're like, we want our money."
And if you don't pull it out, they're still gonna get their money, and you didn't get your money, but they're gonna charge you taxes anyways.
Yes. And so for those people that find themselves in that RMD stage where they're required to take money out and they're taking the standard deduction every year that we already talked about, then there's ways to satisfy the RMD and give to charity above the standard deduction line. So it actually reduces. So when you reduces your 1099-R. So whenever you take money out of a retirement account, you're going to get issued a 1099-R. That is like Fidelity or Schwab or whatever. They're going to report to the IRS the amount of distributions you took and how much taxes were withheld on that. They're going to send a copy to the government, a copy to you. if you donate some of that stock in your retirement account directly to your charity of choice, if you're going to give already, then your 1099 is going to satisfy the RMD. Let's say you have to take, the government says you have to take 50 grand a year out of your retirement account. You could give 20 of that to your church if you're going to do it anyway. And then your 1099 is going to have a nice $30,000 on there with a $20,000 QCD, qualified charitable donation. So you're giving to the charity right out of your retirement account, satisfying your RMD, and you're reducing your taxable income with charity outside of itemized deductions. So you could still take the standard deduction and you get the charity, um, removing your taxable income directly on your 1099.
Yeah, and then you don't get hit with R&D tax. You got to satisfy some, if not all of your R&D. It's a beautiful thing there. Um, okay. Now we get into a little more complicated stuff. What shall we get into? What would you like to start with?
Um, we could do donor advised funds. I mean, donor advised funds are very popular too. Donor advised funds, um, requires a little bit more due diligence, but when you set them up, you get a very big deduction, typically that first year. Um,
Like a perfect example, let's say you're working and you guys are about to get a big bonus, or your company you're working for, you've got some closely held stock. They're doing a merger. You're going to get a big payout, like one of the biggest payouts of your life, but you still got a career. You're not retiring now. That year, you have a huge amount of income. But you don't know who you wanna give all this stuff to charity. Oh, we should talk about we missed this fundamental part. Charitable giving does have limitations even if you are itemizing, right? Cash gifts, you can't give more than half of your adjusted gross income. This changes from time to time with different tax law, but generally half. If it's property, more than 30% of your income. So in years that you have higher income, you have the ability to give more to charity and get that deduction. So let's say in this example I was trying to start with, you have a big year, one of your biggest years ever. You've got $5 million coming to you. You could potentially give 2.5 million away, but you want to be smart. You want to be a good steward. You don't want to just throw money at charities that you don't know where it's going to be used. Maybe you have a specific charity, like I have one that's near and dear to my heart. You throw them $2.5 million, they wouldn't know what to do with it. It would cause problems, right? Well, let's say when they break that out over the next 5 or 10 years, that's a perfect example of when a donor advised fund is awesome, because you get the whole deduction that year, but you get to decide and be more deliberate, and take longer over how that money gets out to the charities.
that's right.
Any
Yeah,
more
no,
detail on
that's
that?
exactly right. Yeah, you influx your own fund. You basically set up your own donor fund. You contribute the 2.5 million in that tax year in the high income year. You get a 2.5 million dollar charitable write off, but then you're not just bombarding the charity with $2.5 million. Instead, you're going to give, however much you want over the course of several years. So it's you get the big deduction and you get the flexibility of donations later, but you don't get the donation, you don't get the deduction again when it comes out of your fund. You get the deduction when it goes in there. Then you can appreciate the property and you can hopefully grow that $2.5 million that's being invested and grown. But it's marked for that charity. You have to mark it for that charity. So you can't just change your mind and pull it out of the DAF.
So there's I'm the paranoid partner out of the two of us, right? And there are things that worry me. The IRS says for the donor advised fund to work and you get that whole deduction over that year, when you fund the DAF, uh, you can't force them to give to the charity that you want. You can only advise them. And you look, I read Schwab's DAF rules once, and it seemed reasonable, but they have a fiduciary responsibility to you into that fund, but they have to have the ability to choose not to follow your advice. I don't like that. I don't like giving up power to other people. Never seen anyone get in trouble with it, but just be careful with that. There's some other ways where you can have a lot more guaranteed results of where that money is going to go. These are called charitable trusts, CRATs. You want to kind of cover the basics of those?
We can hit it pretty quick. I think we're going to actually have our tax attorney on a podcast, so we can go into very detail of cruts and crats. But the big overarching theme is you're going to create a trust. You contribute to that trust, and you actually get a pull and an annuity on that trust. So you actually have personal income on there, and you get to receive income off that donation over time. You set that percentage amount, and you get an actual income. So if you put $2.5 million into a charitable trust, then you would get a $2.5 million charitable deduction, and then you actually get some of that 2.5 when invested. You get an annuity
Yes.
off that.
And there's about 1,000 different variations of that where maybe you're not getting the annuity, but, your state is, or another charity is, or maybe no income's coming to your estate, but you're getting to dole it out to the charities that you insisted on and rule that from beyond the grave after you die. So those are really cool. We recommend you tune into that episode, hopefully next month, on Hidden Money when we have our awesome tax attorney who joined our firm. He's going to come and give us 4 podcasts on stuff that's way over Kevin and I had.
That's
Not,
why we need to have him
yeah,
in here.
it's going to be exciting.
Yeah, as tax guys, it's like the tax code is too thick to know everything, and so we have a lot of phone a friends, which is very. I think it's just part of being. I mean, we just know our weaknesses, we know our strengths.
Yeah,
We
you
have a
ever
lot of
find a
strengths.
tax strategist that said they know it all? Run,
Yeah, it's
run
impossible.
quickly.
It's impossible. We have a network of people that help us enact all these strategies because you need them. But hopefully, this episode helps you at least get a good foundation. Remember, 501(c)(3). It's got to be a qualified charitable organization. Keep your documentation. Keep those letters on file for at least 7 years. And just make sure that you're maximizing your charitable giving the best you can. If you're in a high income year, there's so many ways to reduce a tax bill with charitable giving, not just straight cash giving. You could be a lot more strategic with it. And if you need any help analyzing, maybe you give a lot to charity and you're like, maybe there's a better way to do this. Might be. Just reach out to us, let us know, and let's just have a conversation.
Absolutely. So there are ways to slash your tax bill with charitable giving, but it's not the only way. All tax strategies should be considered together and comprehensively before you decide what you want to do. There's an occasion charitable giving is the only thing you should do that year. Rarely do we see that. Usually there's a whole bunch of other strategies. And if you've got other strategies in mind, you need to make sure you're balancing them together so you're getting the greatest benefits. You're able to keep what you have legally worked your life for and worked so hard, you get to keep the money that is rightfully yours. Don't give it to the IRS. We'll see you next time on the Hidden Money Podcast.